Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod. Let's call the whole thing off. A couple of corporate deals withering. A mega grocery store merger dies, and the White House blocking Nippon's purchase of U.S. Steel.
Well, the question is, do you think steel is a
national security? Is Japan a national security threat?
Not now.
The road to the public market for fast-growing startups. Venture investor Mitchell Green.
The best companies raised so much money in 20 and 21, they effectively completed IPOs already.
As private businesses.
And will 2025 be naughty or nice for the supply chain and consumer prices? The head of one of the nation's biggest ports weighs in on the tariff threat. Port of LA's Gene Seroka.
In the last quarter plus, you've seen retailers, footwear, clothiers front-loading inventories to average that cost down in the event we see a widespread tariff implementation.
All that today on the podcast. It is Wednesday, December 11th, 2024. Squawk Pod begins right now.
Stand Andrew by in 3, 2, 1. Cue Andrew.
Good morning and welcome to Squawk Box right here on CNBC. We're live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin along with Joe Kernen. Becky's off today. It's only Wednesday.
Federal judge has blocked Kroger's $24.6 billion acquisition of Albertsons. She sided with the FTC, ruling that the takeover would lessen competition for U.S. grocery shoppers. The FTC had argued that the proposed tie-up violates antitrust law and that a divestiture of hundreds of stores wouldn't do enough to replace the lost competition. Kroger and Albertsons say now that they're reviewing their options. I don't know. It always seems simple to me that they were missing the real place where the competition lies.
Which is?
Walmart and Amazon. And that the margins are so small that this is probably something that would actually help Kroger and Albertsons compete against these behemoths, not to dominate the market, but merely to just.
I mean, I think part of the problem, and I don't disagree with that, but part of the problem was that food costs, you know, people are still paying 20% more than they were, you know, we talk about 4 years ago.
22% more, yeah.
Right? And so I think part of this, again, whether you think it's real or you think
it's. Could be misguided, and they'll conceive that for what really.
Well, the question is, why are we up 20% with food costs across the country?
Well, we know why.
Well, I think there's a lot of reasons why.
There are. But if you have a supply-constrained world post-pandemic and you pile a lot more stimulus on.
Right, so that's a huge component. But then the second question is, there are going to be there are markets that don't have a Walmart and that don't have an access.
Right.
And so that's the sort of part of the Albertsons Kroger conundrum. And I don't know what you do about that.
I go to a supermarket where I'm telling you, and it's convenient, and there's a reason I go. I guess, what do you say? You don't criticize my name. But compared to a place that's not that much further, I mean, I pay like grapes. I can pay like $13 for some grapes. And it's specific to this. It's kind of a high end. It's in Short Hills. It's kind of a high end. It's kind of like whole paycheck markets, whatever that's called.
I know about those places.
Yeah, Whole Foods, same kind of thing. And it's convenient. It's great. I know where everything is. But I know. I'm probably paying 40% more than I would at the nearby Stop and Shop.
President Biden planning to formally block the $14 billion sale of U.S. steel to Japan's Nippon Steel. That's according to a Bloomberg report that says the deal will be referred to him by the Committee on Foreign Investment in the U.S., or CFIUS, later this month. That's when that's supposed to happen. The report saying that U.S. Steel and Nippon are ready to pursue litigation over the process if President Biden does decide to block the deal. And the thing that I wonder about in all of this is where President-elect Trump will ultimately land, because
he said the other day, didn't he? Did he block it?
He blocked it too. But the question is there any world in which a deal like that gets sort of brought into this grand negotiation that we seem to be happening around the world with lots of different players? And I don't know.
You go and look at the globalization and do your Ben Franklin close, all the bad things and all the good things. It maybe anti-globalization wins out. I don't know. Maybe it does when you add everything up. But there's like 15 things on each side, positives and negatives. And there are positives to
I think they're huge positives.
There are huge and this probably should go through. And the sort of the nationalistic tendency here might be counterproductive and have unintended consequences. And we want to be able to buy things other places.
Well, the question is, do you think steel is a
national security? Is Japan a national security threat?
Not now.
Right. They learned their lesson from World War II. Let's get the latest staffing. They barely have a military at this point.
What are you going to say to Senator today when you meet with him?
I'm going to listen.
How do you feel about a shadow Fed chair? I know you had called for a shadow Fed chair. Are you still on board with that?
Today on Capitol Hill, President-elect Trump's pick for Treasury Secretary Scott Bessent is going to meet with several members of the Senate Finance Committee. Yesterday, Bessent spoke to CNBC about Fed Chair Powell serving out his term.
As the president said on Sunday, and I am in complete agreement with him, that Jay Powell will serve out his term and leave the building as Fed Chair on May 26th.
You know, when I spoke to Jay Powell last week, one of the things that he commented about was that historically, I think for the last 75 years, the Treasury Secretary and the head of the Federal Reserve have had a breakfast or lunch together almost every week.
Yeah.
That's part of the job. And I thought, I said, well, that first lunch may be kind of interesting, because Scott Bessent was the one who very publicly in Barron's suggested that Trump not fire him necessarily, but create this shadow Fed chair by effectively nominating somebody else long before he could ever finish out his term, with this idea that somehow through forward guidance, if you will, that the investor community would sort of see through or discount anything that Powell was doing, knowing that in 2 years from now you were getting this other person who was going to do whatever you think they were going to do. So I don't know.
There's got to be trust and mutual respect and acknowledgement of the different authorities and boundaries that we have, but a very constructive relationship, because, in times of crisis, we work much more together under the law. Nonetheless, it's a very important relationship, and I'm confident that we'll have the same kinds of relationships with the incoming administration.
That first lunch, though, is going to be interesting.
It's going to be fine.
Powell was very adamant that he thought that there would be a relationship and that they'd figure out a way, and he's somebody who believes deeply in the institution, the independence of the institution, and clearly I think maybe Bessent's now getting on board with that as well.
A lot's happened since Trump used to sort of verbally try to influence Jay Powell. I don't see how anyone could have been more dovish. I mean, Trump could have looked at what happened, how long the Fed stayed at zero. It's like, this is my guy. You know what I mean? How can you think putting Warsh in versus Jay Powell? I mean, Jay Powell might be Trump's guy at this point. He'd be my guy. If I like lower interest rates, Jay Powell would be my guy.
Well, that's
and things can change.
We've had a lot of conversations.
Things
Kevin
can
Warsh
change.
has been obviously a lot more hawkish about how
things can change. It's like, be careful what you wish for.
GM pulling the plug on its robo-taxi operations. The company cited the high cost to develop the technology and build out a fleet of cars in multiple cities. Instead, GM now is going to merge its self-driving unit Cruise into its operations with scaled-back goals, including developing advanced safety systems and one day, they say, offering autonomous driving as a feature on future models. On a call yesterday, company CEO Mary Barra saying, quote, "We looked at the amount of money to deploy a robotaxi business and to maintain that business and grow it. It's quite a bit of capital." She said the GM will now focus on its core business. But what this really means, it's a boon both to Elon Musk and to Tesla, and it's a boon to Waymo and the folks at Alphabet. And, so interestingly, when I talked to Sundar last week at DealBook, one of the questions I asked is, do you ever see Waymo being such a big business that you could spin that off? And he was open enough to that. I could see one day Waymo being its own company. And we were talking about even artificial intelligence and just sort of the success or the perception that, ChatGPT and these other guys are doing AI. And he sort of looked at me like, well, Waymo is the most real world AI machine, that exists. So it's interesting to see those two now pull ahead in a big way. And Cruise is now, GM unfortunately has spent an enormous amount of money trying to play in the game.
And did we ever really think that one of the legacy automakers were going to be the lead when you're up against these
big tech
incredible
giants.
big tech
Well,
companies.
so that's the question, though. Do you think that the legacy players can ever get out of their legacy way?
Do they? Because if I was going to, in saying something positive about Mary Barr and Jim, you've seen the stock. Stock has done incredibly. So they're doing in areas where they can still play. I think they can succeed. Would I want to go up against Tesla and Waymo in terms of I'd let them do it, and then I'd like license it.
Well, but that was the model, or at least the way people thought about like Stellantis. So Stellantis never really invested in any of this stuff. They've never even tried to play in this game. Their view was, we're great making a Jeep Wrangler, and one day, if Waymo and Google guys ever figure it out, we'll just license the technology from them.
Yeah.
Maybe that's the better way.
I think of a lot of different, like, would you go to, pick your IBM or something for the next generation cloud? Maybe you would, but probably not. The baton gets passed. It does. Seems like, because you need a bunch of them 25-year-olds, I think, in there instead of the people like me, thinking the way we used to in the 80s.
Cheese will be next.
Coming up next on Squawk Pod, taking good ideas to Wall Street. The flow of companies from private to public markets with an investor who backed Uber, Spotify, Alibaba, and Bumble. Mitchell Green from Lead Edge Capital.
I think there's been about 10 tech IPOs over the last 12, 18 months. And 9 out of 10 of them were above the IPO price at a pretty good amount.
The public offering opportunity in the new year, right after this break. Welcome back to Squawk Pod.
Up and Andrew, Q.
You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin along with Joe Kernen. Becky is off today. IPOs in 2024 so far have raised now more than double since last year's listings. And another tech company going public tomorrow joining us right now on the IPO window, and so much more just going on in tech and everything else. Mitchell Green is here. He's the founding partner at Lead Edge Capital, which is now invested in companies like Uber, Spotify, and Alibaba. The year's almost over, my friend.
Almost over.
It's almost over, but it's almost vacation time.
They're going to get one more in.
They're going to get one more in, but the question is, what do you think 2025 really portends here?
It's going to be better than 23, better than 24. It's not going to be a blockbuster year.
It's not.
I don't think it's going to be a blockbuster year. I think the issue you have, and if you actually look at the data, we had looked at it at our annual meeting like a month ago, and I think there's been about 10 tech IPOs over the last 12, 18 months. And 9 out of 10 of them were above the IPO price at a pretty good amount. I haven't looked at Reddit in the last couple of weeks, but that thing had like Sword and ARM and a bunch of these other things. The biggest issue you have is the best companies raised so much money in 20 and 21. They effectively completed IPOs already.
As private businesses.
As private businesses, correct.
Yes. And therefore, you're going to get into the same kind of situation that Stripe is in today?
Correct. I mean, companies such as Grafana Labs, who just did a big secondary that was announced, Stripe. If you think about it, between 2005 and 2019, when a tech company went public, it would raise $100 to $500 million. Okay, forget Alibaba and Facebook and some of the giant ones. Well, now fast forward to 20 and 21. How much money did companies raise? Like $100 to $500 million. You have companies that have $300 million on the balance sheet, like the best companies, which there's probably 10 to 15 Stripes. If you ask the bankers at Goldman Sachs or Morgan Stanley, you'll get there's 10 to 15 companies like a Stripe or a Grafana or things like that. Now there are hundreds of other unicorns that raised that are 100 to 250 million of revenue.
Right.
The issue is they're not growing that fast, and they're all negative 10 to plus 10% operating margins. And if you look at the way public companies are trading right now on like rule of 40, which is take the revenue growth plus the EBITDA margins. If you grow 50 and have a negative 10 EBITDA margin, you're rule of 40. But
explain that again. The rule of 40 is?
So rule of 40 is a metric that a lot of investors use to just describe like what is a good business. And a good business, people like to say, is rule of 40. And what that is revenue growth rate in the current year plus your EBITDA margin. Okay. So if you are a rule of 60 business, if you have, 40% growth,
Right.
and 20% EBITDA margins.
Okay.
You are a rule of 0 business if you have 30% growth rates and negative 30% EBITDA margins. What you have a lot right now, and a bunch of these like unicorn companies that raised, look, they all missed their financials they originally thought they were going to hit. And so you have a bunch of businesses growing 20, 25% a year that have negative 10 to positive 10% operating margins. And so you got a bunch of businesses.
Rule of 0.
Rule of 0 to rule of 10.
Right.
Those businesses, if you look at the way they trade on the public markets and just look at how segment all the software companies by rule of, start at rule of 90 and like the Datadog, Snowflakes of the world, and take them down to rule of 0, it is directly correlated with very high correlation. And a rule of 10, rule of 20 business trades on average 2 times revenues or something.
So do those become zombies? Do they become acquisition targets? Do you
zombies for a while? At some point, they will become acquisition targets. The challenge for them is, not challenge, is they have so much cash.
Right.
They themselves have hundreds of millions of dollars off it on the balance sheet, and venture capitalists and private equity investors love to just waste their time and sit on boards forever. Why take the mark and sell it at half the value you have it marked at, when you can just sit on it and try to convince your investors for a decade that it's worth what it is, and try to grow into the valuation. There's all these people want it. It's hopes and dreams. It's we're going to make this one change and then it's going to grow again and we're going to take it public. Yeah, the amount of companies that reaccelerate after they get to 10 to 20% revenue growth is so rare. And then I think the other issue with the IPO market is you get the venture funded companies, and then you have the big buyouts.
Right.
The companies that Hellman Friedman or Blackstone and Ares and Apollo own. They all have lots of debt on them. They don't grow that fast. And third, they own the whole business. So when you take them public, you get it. We were an investor. We do some stuff on the public side, and we owned a business. It's publicly disclosed in structure that Thoma Bravo had taken public. Mm-hmm. It went public. Post deal, they owned 90% of the company or something to that effect. If you're Fidelity, Wellington, T. Rowe, please explain why you want to buy the position down from 90 to 80 to 75. You have a wall of selling in front of you. And so the challenge becomes just getting these big institutions interested in wanting to buy the positions and massively concentrate. I think it's a big issue.
More broadly, before we go, what is your sense? Just the market has moved. Obviously, it's been a huge move this last year.
God bless Donald Trump.
Right.
Yeah.
And my question is, if we have this conversation again same time next year, where do you think things stand? Do you have any?
We're not experts in the market. You have Steve Cohen or Paul Tudor Jones come in and things like that. The economy is pretty darn good. Our companies are hitting numbers. If I talk to colleagues at private equity funds and venture funds, things are doing well. There's still, I don't know what the concentration. You've had, I think, more of a rally in the last 4 or 5, 6 weeks in small cap companies, so that's started to adjust. But look, I think Warren Buffett has this ratio he uses of market cap to GDP or something, and I think it's pretty high. So look, what I do know is that markets don't move. Markets move in the ways that cause the most amount of pain to the greatest number of people. People appear to be pretty bullish right now if you look at leverage ratios and on hedge funds and things like that. And you're probably one geopolitical event away from something big happening, but who knows? I have no idea.
One geopolitical event away.
Mitchell, those look like Taylor Swift bracelets.
They are Taylor Swift bracelets. I have daughters who are giant Taylor Swift fans. Did you go to a concert?
Of course, but I haven't made those, but I have seen people make those, and they made me one that said, I think mine said Red because I like that song or something. Yeah, and the tour just ended, so that really is.
They are Taylor Swift bracelets, yeah.
For your daughters.
For daughters, yeah.
For your daughters. Okay.
For your daughters, yeah. All right. Yeah. Still wear them. Make them happy.
Whatever you say. Okay.
Amazing phenomenon.
Mitchell Green, one of the great Taylor Swift fans of our time. We appreciate you being here. Everybody's a fan.
Mitchell Green.
Everybody's a fan.
Next on Squawk Pod, tariffs and the future of trade with Port of Los Angeles Executive Director Gene Seroka. What he calls the most polarizing part of his industry.
If we can find a way to double capacity, which is what robotics can do, but not cut the workforce by 50, 80% at that individual facility, I think you got a conversation starting right there.
We're back after this. You're listening to Squawk Pod from CNBC. Today with Joe Kernen and Andrew Ross Sorkin. Here's Andrew.
President-elect Trump's tariff plan could put some $3 billion in tequila and mezcal imports at risk. It's according to a Reuters review of Mexican customs data, highlighting really the risk for products like tequila that can't be made elsewhere. Diageo imports about $1.6 billion worth of products from Mexico, including what's wrong with my Casamigos also. The parent company of Cuervo imports a similar amount from Mexico each year. So got a lot of.
What'd you take in high school? Not Spanish, apparently.
Not Spanish.
No, me neither.
French.
Why do I even ask? Why would I even ask?
And we always have Paris, Joe.
Yeah, we do.
We'll always have Paris.
And you know what I took? Brilliant.
We take Latin?
Yeah, in case I ever go to Latinia. Yeah. Which Dan Quill actually thought.
Can I just say my son takes Latin, and I think that I should have.
I
think
do not.
It's great.
You want to hear my sum total of 4 years? Porto, Portavi, Portatus, Agricola, Agricolae.
You really then start to understand the English language.
No, you don't.
You don't?
No.
Okay. I feel like I've had very in-depth conversations with my son about Latin words that I didn't realize were.
It'd be better. Look,
okay. Joining us right now to talk about what's going on in Mexico and the tariffs and everything else that's happening in our ports is Gene Seroka. He is the Port of Los Angeles Executive Director.
What'd you
Good morning
take?
to you.
What'd you take?
What'd you take?
Ni men hao, ni wei shou zhongguo wa ma?
Wow.
See, that would have been smart.
See, that was valuable.
That
It
would have
helped.
been.
I worked in China for about 4 years.
Damn.
Still rely on those guys a lot, as we've talked about before.
See, talk to your kid.
Okay, so explain, what is your expectation as it relates to tariffs, just broadly? I mean, you've been watching this whole thing play out. You're at the literal epicenter of it all. What do you think is really at stake, and what do you think could happen, will happen?
Good morning, Andrew. Great to be back with you guys on the set. I think what I've learned is there's a long way from the campaign trail to public policy.
Right.
And while we're not dismissing anything, I think industry, the workforce, and ports like ours want to know where and when, so we can begin to plan and adjust. We're doing all kinds of simulations trying to figure out, okay, if cargo ships here, if it goes there, what do we do? How do we respond? Let's get a little bit of line of sight on what's going to happen from a policy standpoint, and then we go to work.
Right, but everybody doesn't know what the line of sight is.
That's the question.
And there's a secondary issue, which is it's not just what's the line of sight, it's when do you even learn what the line of sight is. How quickly will it take you to rethink plans if, in fact, you get that line of sight?
We're going to have to pivot quick, and we already have some experience in this. When the first round of tariffs went in back in 2018, we saw a movement away from China sourcing manufacturing in Southeast Asia, right, Vietnam, et cetera. We closed out 2022 with about 57% of our portfolio being trade with China. Today, it's 43%. And if we put more tariffs on China, we'll see that percentage go down as well. But again, how quickly can it happen? Some experts are saying by summertime, by third quarter, maybe fourth quarter. And what the key is going to be is our speed component. That's how we've done so well with North Asia cargo coming over Los Angeles and distributing across the country. If we have nonstop services like we've seen over the past couple of years start up in Southeast Asia, we can maintain our competitiveness.
Okay, so anecdotally, we hear that there are some companies that are trying to get ahead of this situation and that they're trying to ship as much stuff over here as humanly possible now in an effort to get ahead of a potential tariff. Do you actually see that physically?
Yeah, we do.
You do?
Yeah, we do. The volume has been elevated. This will be the second best year on record at the Port of Los Angeles from a volume perspective.
But how much do you think of that is just a function of hopefully a great economy versus folks sort of trying to overthink? I don't know if they're overthinking, but as it relates specifically to the tariff piece.
Yeah. The underlying economy is strong and has been continuing longer than some would have thought. We're still buying. The manufacturing sector is doing pretty well overall. Then you've got three big geopolitical issues. Right. The dock workers negotiation back here on the East and Gulf Coast, which is set for expiry on Jan 15th.
Oh, boy.
You got the drought conditions in the Panama, which seems to have settled down, but you weren't having as many ships go through, nor were they loaded to capacity. And the ongoing security concerns with the Houthi rebels in the Red Sea. Suez Canal crossings are down 80 to 90%. Now, in the last quarter plus, you've seen retailers, footwear, clothiers front-loading inventories to average that cost down in the event we see a widespread tariff implementation, whether it's 10% on all $3 trillion of American imports or more targeted, like 60% on China, impacts on Mexico and Canada trade. That's it, and it's a repeat of what we saw in 2018.
What do you think the chances, by the way, on the East Coast that we have a strike?
I think it's pretty tough. It comes down to the discussion between the union and the employers on robotics or automation, and it's the most polarizing discussion we have in our industry today.
Can you do it? I would think that the future has to be robotics, no?
If we don't leave the workforce behind. There are models like in Hamburg, Germany, which have flourished. You grow capacity, top-line revenue, margin play, and you don't cut back the workforce to big-time levels.
Right.
If we can find a way to double capacity, which is what robotics can do, but not cut the workforce by 50, 80% at that individual facility, I think you got a conversation starting right there.
Right, but here's the question. Could you do this without the people? With a meaningful cut on the people, or no?
In my opinion, no, because you've got communities, you've got policymakers and politicians who have jumped on this discussion point, making sure that their communities are healthy from an economic standpoint.
By the way, I want the community to be healthy. No, I'm just asking from a pure, just technical perspective. You know, if Elon Musk was building a port, would the port have people? How many less people would be in that port?
From what we've seen so far, we've seen terminals automate, cut 80% of the workforce on that facility. And the results have been mixed on the West Coast thus far. Now, you can work longer hours, your cost per unit of throughput becomes a little cheaper, but the level of service, because we're a gateway, going from ship to truck to train, is a little bit intricate. That institutional knowledge, I don't think can ever be put to the side.
Thank you for coming in this morning. It's great to see you. Happy holidays.
Good to see you guys.
I mean, they have so much leverage, I think. And we heard last time, I can shut the country. He can.
Remember he said that, right?
He can shut the country down. Because you go into a place that if any of the shelves are bare, it's like, what's happening? This is not. I mean, we take so much for granted. It comes off the ship, onto the truck, into the rail. So January 15th. And they're not going to go quietly?
I don't think so. No. I think they're pretty far apart. And while we got that tentative agreement back in the fourth quarter, this automation concept is really going to come down.
Yeah, it's existential.
That's the biggest thing.
All right. Thank you.
And that is the pod for today. Thanks for tuning in, as always. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Tune in weekday mornings on CNBC at 6 Eastern to get the smartest takes and analysis from our TV show right into your ears. Follow Squawk Pod wherever you get your podcasts. That's it. Have a great Wednesday. We'll meet you right back here tomorrow.
We are clear. Thanks, guys.